Good afternoon. It is our 3 p.m. Just as usual. I am here, you are there, and we are exchanging ideas. We are beefing up our knowledge related to taxes. A lot of times when the one big beautiful bill got passed, some of our small business owners didn't think that was anything related to them. They don't think it's related. They think it is all for benefit of some big companies and it's not about me. And I want to say that, don't say that. It is actually related to you, and I'll show you why. And today, of course, I did not choose all the items to come into this session. And I picked up several that is maybe hard to understand, but yet is related to our small business owners. So I picked those ones and to talk about it and give you examples. If I have real life examples of my own, I will explain that to you. Otherwise, I put a number on the screen, calculate number with you, so you understand what kind of credit, what kind of saving we're talking about, right? So the title we have today is OBBBA, Business Tax Changes for 2025. I want to focus on 2025 because the OBBBA did something different in 2025 than going forward in 2026. Some of these items are not exactly the same this year or next year. So I want to just focus on 2025 and show you what you need to do this year. All right? So small business owner must know, which I really think is related to you. Before we started our webinar, we always talk about our website, communitycpa.com. Go onto our website to look at what we can offer you. You can onboard with us without even talking to us. You click on board with us, sign up, then you can upload whatever you want us to do and see. Then you upload, we will call you back. We will contact you. So you don't have to be, you don't have to break the ice if you're new to Community CPA, just felt a little shy to talk or felt very obligated, feel bad to leave the older content coming to new ones and just don't know how to say goodbye to your old friend and coming up with a new time. I always tell our business that, in our life, we all go through stages. Sometimes when you started, you are a small business, your next door neighbor might just be the right one to help you. But when you grow to be a legit business and running $10 million, $20 million under your transaction, and you are still doing these sidekicks, that would not help you because government coming in for compliance review, it will completely destroy and invalidate your whole practice, your whole career. Half of your life worth of energy will go wasted. So don't do that to yourself. When you grew to a certain time and you meet certain people, that's what we call grow, right? That is why when I wrote a book of starting a business, growing business, then my third book, expanding your business, they're just not the same thing. They're different in business life. So for you, when you are in your business, you got to realize, oh, maybe now I am at the place I need to step up to a company like Community CPA to serve me instead of staying with where you are. It's a business decision. It is a decision that would help you or break you. So you might want to consider that to be a decisive moment, what you want to do. Now, on our website, you also can make appointment with us. We come on and meet you on Zoom, on link, on the video talk, so we can discuss what you need to answer. This morning, I had a gentleman coming on the video, like he got my time from appointment button. He said that he's not sure is worth it or not worth it, but he's going to give it a try. So at the end of the meeting, he said to me that it was so worth it and it is a very good investment that he did. I answered all of his questions. So that is how confident I am to be able to answer your question, and I want you to be confident in us knowing that we can resolve your questions. All right, and this is a summary of our firm in a snapshot. We can quickly skip that and you will learn it on your own about our firm. But this is our YouTube channel. Our YouTube channel is all the webinars I talk right now. It is going to show up here. So you don't have to be here at 3 p.m. and you can always go in to search what was happening and what was being talked about, and you'll find us. These are the 2 books I was talking about. I already published this too. I have the 3rd one coming up. Every stage of business, it means something different. Not only about your business is different because you're making 200,000 in the beginning, now you're making 20 million. So business is different, you are different. And the people who are around you should be different. And you will realize the limitation if you kept the original team to work on your business till you from 200,000 a year revenue, now you're 20 million. You tell me that you still have the same team. That's amazing. Normally do not happen because people don't necessarily grow with the business. What people do is they're good with certain stage of the business, but they don't necessarily grow with the business. So that's very normal. By the time you reach 20 million, your accountant is different, your secretary is different, everybody is different. So that's just expected. All right, so no responsible disclaimer. You know what I'm trying to say. So let's just dive in, see what we have today. My very first one is this R&D expensing coming to you. The reason I say that, so if you are in the business where you do a lot of research and development, just the word itself suggests. Research means that, you have a chemical compound and you want to make it in certain ways to have a certain function. Customer may place order for you, but you don't have the answer yet. You want to do experiment to make sure that it works and make sure that the compounds are, a right mix, wouldn't expire by the time it's shipped to the customer. So all of these things are your research and development. And at the IRS, the federal government give you some incentives for you doing that. What they are doing is that they're saying, all the expenses you have on the research and development, we can somewhat work into a formula and give you a tax credit. Tax credit just means that if I give you a $10 tax credit, that means if you pay $10 taxes, you will get that $10 back. You won't pay it because it's offset by your tax credit, right? Some tax credit is refundable, means it is cash to your pocket. Some tax credit is not refundable. It's just sitting there waiting for one day you pay taxes, it comes out to offset your tax. So it's a non-refundable tax credit. R&D research is non-refundable tax credit, all right? So if you pay taxes, you don't pay taxes because your R&D tax credit coming in to offset that for you. But how do you get that tax credit? The first step is for you to recognize your expenses in your organization. How much of that is R&D expense? Maybe you're the owner, maybe all of your salary is, because you're the one heading the research, doing all these experiments. Or maybe half of your salary is. Then the material you bought and tested, wasted, all of those materials are eligible expense. Of course, they are already expense, right? In any case, they get deducted. But deductibility doesn't change. The thing is, normally, if you spend $500 on utility, there's no credit. But if you spent $500 on the R&D, that $500 can turn into $50 on tax credit. This is what we're trying to just give you the concept, not to say that you have it or you don't have it, how to do the calculation and what formula you use. Don't even bother with that. You just want to understand the concept. So in this one big beautiful bill, it made a significant change to this rule. In the past, what happened is they say, okay, you cannot deduct all the expenses if you're gonna make it a R&D expense. So this OBBBA just said, forget it. It is expenses. You don't need to amortize it. You can just deduct it and also calculate tax credit. With that said, the OBBBA also allow us to go back to year 2022. So you can go back to 2022, 2023, 2024 to amend your taxes to recognize the tax credit. So that is very significant. And if you are in any type of business, as long as you have research development type of expenses, you should definitely look into it. But of course, you may ask me, oh, Ying, but I don't know this is a research development expenses or not. That is where you need to engage professional to help to get your case wrapped around, right? To identify, to do analysis on your case, to categorize your expenses, to make a case and do analysis and then submit to IRS to get that passed through. And those are the things your professional folks can do. There are also companies who are not CPAs, not attorneys, but they're just doing credit side of work. We refer them as a credit meals. These type of company, you want to be careful just because when they do that claims, they really don't have credential behind them. If they make a mistake, it's your mistake because you're the one gonna end up, putting back what government gave you and refund the money or getting penalized. So those are the company without certain credentials. They can still do that because there's no way to prevent people from doing that. And they can make a good living of doing that. But for you, as a small business owner, you want to rely on the CPA firm, the CPA, the attorney that you can see and you can make a connection to. Do not go for 1-800 number, people you don't even know. Of course, at our firm, we have clients all over the country, but we also have many branches. So you can literally visit one of our branch, and you can also know that we're actually here for almost 30 years. So we know what people need, and we provide consistent high-quality service. So that is not something you would worry if you want us to help you, right? So this slide is about R&D. Then now I want to talk about ERC. This is also showed up on OBBBA. This one, it is putting a cap on the ERC. I know by now, this is already September of 2025. Nobody would claim ERC anymore. But what this act also prevented people from getting any ERC if they submitted the application after January the 1st, 2024 for the quarters in 2021. Okay, so this is just to say that if you have ERC that you submitted for the third and the fourth quarter of 2021, then you actually submitted after January the 31st, 2024, you can pretty much treat that submission as null and void. It won't happen. But anything you have claimed in 2020, even if you submitted that after January the 31st, 2024, the IRS is still going to honor that. So, obviously, the OBBBA also extended the audit period, making ERC wide open for audit for 6 long years. So you want to know that when you submit anything, now maybe you submitted ERC and you don't feel comfortable about it, And that is when you need to engage professionals to really look into your case, making sure that you are sound and you're good and you will be getting the money from IRS. So I just want to bring that into small business owners because a lot of small business owners had claimed the ERC. You may or may not getting it back. You may or may not worried about it right now, but there is a new rules coming out in this OBBBA, and that came out on July 4th, right? So those are things that I want you to be having that back in your mind so you know what question to ask and you know whether to give your energy to worry about it or not to worry about it, right? All right. Then the next one I want to talk to you is about the bonus depreciation. Okay? So the bonus depreciation has been permanently set in the law. So this is what OBBBA has done. So there is no phase down anymore. If there is, in 2025, if you bought a tractor and in the past, you could deduct, in 2024, you could deduct 40% of that. 2025, it will only be 20%. But now the rule came back, says that if you bought it after January the 19th, 2025, the bonus depreciation is yours, 100% deduction. So your tractor can be deducted 100%. We're talking about deduction, right? When we're talking about deduction means we're trying to lower your profit. Lowering your profit means that to have you pay less income tax, right? So it's a tax saving methodology. So we're talking about the 100% bonus depreciation is being permanently set in place. The it is not going to be 20% in 2025. It is actually 100% as long as the property, the qualified property was purchased after January the 19th, 2025. I do have the moment with a client, and he bought a commercial property. Obviously, part of the commercial property qualifies for the bonus depreciation. Then he just doesn't remember what day in January that commercial property was closed, the deal was done. So in that moment, when I said January 19 and before doesn't qualify, I feel like the air froze. So we were waiting for a client to figure out when did you get that done? Can you just pull out your closing document to see the date? So we were waiting for that date. The date comes was January the 28th. So it was good, you qualify. You can deduct a lot of 100%. So those are the things that you want to remember. And you may say that, Ying, I don't like what you're saying. Why is not January the 1st? Why is January the 19th? Remember, that is the date President Trump take over the White House. January the 20th was the inauguration day, right? So that date has a meaning. So that is why. It's not because they actually put a wrong number. Instead of January the 1, they put a 19. It was purposefully done that way to make it really painful for people who bought property from January the 1st to January the 19th, and to realize that how significant that is, the election is. That is the whole meaning of that. All right, a example. I want to give you an example so you can feel the difference. So this guy bought a $200,000 equipment, okay? So under the old law, and this would be only $40,000 deductible because it's 20% of the $200,000. Then under the new OBBBA law, and on the first sentence where say construction company buys a new machinery for $200,000 in 2026, this should be 2025. This is my typo. So under the old law, 2025 would only allow $40,000 deduction. But under the new OBBBA law, the bonus depreciation allow $200,000 deducting. So you can imagine that the $200,000 becoming expense instead of 40. Right there, they saved taxable income of $160,000. If the tax rate is even 20%, they saved $32,000 on income tax. So it's a big deal, right? So that is why those deductions are important for business owner to know. Section 179. So not a lot of our clients are using Section 179. One of the key reasons compared to bonus depreciation and 179, there is a huge difference is if your business is already at loss, let's say before depreciation, your business is netted out. Your profit is $10, your expense is $10, you have a net profit of $0. 179 would not allow you to create losses on your business. So you cannot do more depreciation to have a loss of $200,000. But bonus depreciation has no such a limitation. So we literally can create $200,000 negative losses. But you may say that what's so good about losses? Losses can be good. If you're an S corporation, your 1040 may be making a lot of money. You have $200,000 losses out of your S corporation, you will save so much taxes right there. If your tax rate is at the top, then you save $80,000 taxes just by passing on the loss to your 1040. But you can't do it with 179, right? So 179, it is one business has a lot more profit. And the bonus depreciation didn't even help. You can use 179. So the two can be used together. Just not duplicating the benefit, but you can use that together. You can have some of the equipment go for bonus, but some of them go for 179. So 179 also increased by threshold. Basically, it used to have a cap, right? To 1 million to 2.5 million cap. But now that cap literally doubled. Literally, it's almost doubled. It's 2.5 to 4 million cap. The amount, are also scheduled to adjust for inflation in the future. So it is going to be keep on increasing, and it started at a lot higher amount. Allow business to deduct more, basically. All right. So these past two slices we were talking about, it is on the depreciation side, right? So the first slice we have was on the R&D. You should, I really hope that my English is so ordinary. I don't have big words. I sometimes call my English Chinglish or not perfect English. I really do know. I apologize for that, but I also know that because of my handicap in English as a second language, so my whole 30 years U.S. side of life is about finding simple ways to express complex ideas, because that's the only way I can do, right? So for that reason, I think I have a lot of comments and compliments from folks who are working with me, because they felt like, I have people telling me that, oh, Ying, I know you don't speak Spanish, but I only understand your English, not other people's English. I know why, because the way I help myself, it become the way I help everybody else. So if you are shy away from understanding sections, tax code, this silly, numbers people talk about, oh yeah, you should do 163J adjustment. That doesn't mean anything to anybody. And I don't do that. I actually try to translate everything into the meaningful layman language. That's for myself and also for you. So I hope that the slides I come through had really registered with you. You're like, oh yes, I understand. I know what you're talking about, Ying. That is the whole purpose, right? Now, I want to also to show you that those are special, the special depreciation for production property, okay? this new OBBBA created a new tax incentive following 100% first-year depreciation deduction for qualified production property, defined as newly constructed, non-residential real property used in U.S. for manufacturing, production, refining of tangible goods. Applies to property where construction begins after January the 19th, 2025. So what am I talking about here? You understand that when you build a building, some part of the building is under the 20-year depreciation, so bonus depreciation applies. But some of the building are structural related, so they are going by the 27.5 and the 39 years. Okay? So straight line depreciation. What happened right here is OBBBA set up a new category. They call that production property. Production property means those property built not to build luxury bedrooms, kitchens. No, they're not like that. They are manufacturing facilities. I can quickly think of maybe 3 of my clients. One of them are building a manufacturing facility, and I do know that their ceiling requirement is tall because their machinery goes, they pump that a lot higher, then drop it down to use the gravity for certain production needs. So those are the things the factory was built. That whole thing is 100% first-year depreciation deduction. Imagine how powerful is that. If you are in manufacturing, if you are in production, and you're assembling goods in the factory, then you have this off the bat. No longer needing cost segregation service, folks. You don't need it. You can just go ahead, deduct it all. But of course, they're saying that, must begin before January 1st, 2029, okay? And be placed in service before January the 1st, 2031. And also, if you begin that in 2025, it better be after January the 19th. Make sense? So this is a very special one we want folks to know. This is not exactly depreciation, but it is related to production property, a new category. Now, let's talk about business interest. I know a lot of times folks are borrowing money to do business. Then at the tax time come, they were like, what? I cannot deduct it? Really? Something wrong? And why did you not tell me? So our small business owners sometimes get surprised by this. So I want to bring that back because this OBBBA also made changes to the business interest deduction. The spirit of it is that the OBBBA allowed more deduction. If you didn't qualify before, today maybe you qualify. 2025, maybe you qualify. That's why I brought it in right now, because in 2025, if you borrow money to do business, I want you to do this calculation so you know what need to come through, what this calculation is all about, okay? So let's just use example. In this example, they're talking about EBITDA, EBITDA. The word sounds so Greek. It's like, what is EBITDA? Let me just spell it out. This E stands for earnings. B is before. So earnings before what? The I stands for interest expense. T stands for taxes. Okay? Then EBITDA and D stands for depreciation. A stands for amortization. So all of these things are actually are expenses inside your income statement. But when you calculate EBITDA earning, and you will just take your net profit, add interest expenses back, add taxes back, add dividend back, add depreciation back, add amortization back, right? So folks sometimes hear me talking about a lending side of things. We also we help folks to get loans in our firm. So when we calculate how you will show up in front of the bank, when we explain to you, we also say the word of EBITDA. We tell you that, okay, we can add back interest, we can add back depreciation, and to see where you are, and that is your earning, what bank is looking at. So it's a very popular concept. You should not shy away from that. Our small business owner need to get familiar with this Greek, I call it Greek because it's so weird, it's EBITDA, right? So let's say a manufacturing company has a 500K in EBITDA and a 200K in depreciation. So their interest expense is 160K. So these are just numbers I throw there. So right now, the new law allow you to deduct $150,000 out of your $160,000. But before that, you can only deduct $90,000 out of your $160,000. So you see, the new OBBBA give you more deduction. That is because the new one do not need you to reduce the $200,000 of depreciation. They just take the 500K times 30%, then you can deduct it, right? That's 100K. So with that, I just want you to understand the new rule allows an additional $60,000 interest deduction in your current year. So your 2025 should look very different if you had limitation from the past. All right, so make sure, but you may be having carry forward. You may have those interest expenses you were not deducting. It carried over to 2025. So eventually you're going to use it up. But, what we want to say to you is in 2025, if you have business interest limitation issue, you should look at that again. All right, let's go to our next one. Opportunity Zone renewal. Opportunity Zone is a federal program. It is created when President Trump was in the first term. Basically, he created it, okay? Designed to encourage investment in economically distressed communities, like poverty line, 20% and under. So that is the distressed community. The investors can defer, reduce, or eliminate capital gains taxes if they roll the gain into a qualified opportunity fund, QOF. And the QOF invest in qualified opportunity zone property and businesses. So you may say that, really? Okay. So I just want to give you a little more knowledge on this right here. So everyone, nearly anyone can set up a qualified opportunity fund. It doesn't require governmental approval ahead of time. A qualified opportunity fund must be structured as a corporation or partnership. So that is the requirement. Okay. So it must be filing a form called 8996 with the tax return every year. So of course, if you are, the qualified opportunity funds must ensure that at least 90% of its assets are in the qualified zone property, So you will follow the government regulations so that yes, there's more regulatory requirement, but it is not preventing any one of you to do. So small business owners, if you are sitting here goes, I don't know what that is, too complicated, so that's why I didn't really do this, that is on you, right? Because nobody will stop you from doing this. Literally anyone can set it up. But I want to explain to you how that is beneficial from tax side. If you had a situation in 2025, boy, you did so well in the stock market, you net up with a $1 million capital gain. You are like Ying, $1 million capital gain. I pay too much taxes. Is there any way I can defer that so I don't have to pay? Yes, there is. Yes, there is. Okay? So let me flip into the next page, which I have example. Okay? John received $1 million capital gain in 2025 from selling his stock online. That happened to you? It never happened to me, ladies and gentlemen. I tell you that. Don't listen to my investment advisory because of course, this is like 6 years ago. I lost all of my investment on the stock market, and I just got leveled up by other people who bought my shares. So John received $1 million capital gain in 2025 from selling his stock. Within 180 days, ladies and gentlemen, you need to invest in qualified opportunity fund. Use Form 8949 to elect to defer your capital gain to the future. What is the future? So when you use 8949, you know that you don't pay the 20% of capital gain taxes anymore. You save $200,000 taxes right there. John saves that right there. Okay? Defer taxes on the original gain, right? So the original gain and it would be earlier of the two. So I'm talking about 2025, okay? This scenario in 2026 will be different. But in 2025, you would invest in the qualified opportunity funds, and if the funds concluded for you before December 31st, 2026, and you will report gain in the early days. It's either December 31st, 2026 or earlier if the fund got concluded. But if not concluded, you will do it on December 31st, 2026. That means you will pay taxes in 2027 when you file your tax return. Am I right? Right? If John holds a 5 or 7 year investment, because when you put into the opportunity funds, they normally offer you 5 years, 7 years, or 10 years. So if it is 5 or 7 years, John has a base step up. Means that, let's say you did a 5 years. Then your base step up, you don't have to pay taxes on the step up piece because that almost like you already paid taxes. So-called base step up is exemption from taxes. So you got a base step up. Maybe it is 10%. I don't know what your funds will be, but say it's 10%. Then your $2 million 10%, then you are actually paying taxes on 1.8 million. Am I right? So you have a base step up. You will go into your fund, take a look at that. If you hold 10-year investment, then there is no taxes. No taxes on appreciated amount, like on your earnings on that, only original amount to pay capital gain and on much later. So this is where the qualified opportunity fund will defer your capital gain to the end of December 2026. So if you really got a big capital gain, I would look to at least invest a portion into qualified opportunity fund. You will find them. And I actually looked up the city where I am, which part is the qualified opportunity zone. So their real estate and would have these qualified opportunity funds to invest in. So opportunities, these kind of options is quite popular. So you can look into that, right? So small business owners, again, I am talking to you because This is something you need to know. Now, let's talk about another thing. Percentage of completion method exception. The OBBBA also expanded a concept. Not every construction need to do completion method. What is completion method? Completion method means that let's say you complete your project in 24 months. So each year, you will report the portion of income to go with the portion of expenses. So it's by completion method, you recognize revenue every step of the way. The OBBBA actually says that not only a small group of contractors can have the exemption, which means that you don't have to report income every step of the way. You can report the income at the end of the project. They call that contract method, not completion method, right? So basically, is the OBBBA broadened the coverage to cover all the residential construction contracts. For smaller contractors, allow them to defer income recognition until the end of the project. And is permanently changed for the contract entered into the taxable year beginning after July 4th. So why is July 4th, 2025, folks? That was a holiday, but President Trump and his team is roll out this law on that holiday day. So that's why it is July 4th. So if you started your contract after that, you recognize your revenue at the end of the contract. Isn't that amazing? So you don't have to really go through mathematical methodology to figure out which portion goes with which portion. But of course, this one is, really only applied to a certain group of small contractors. So you want to make sure that you qualify. Majority of my clients are qualifying. So if you are my client, and you already qualified because I already checked my data. All right. This is something I just want to mention. There's no math to it. It's just that some of our small business owners, I know, especially the novelty stores, when they importing things from overseas to US, they never really subject to treaty because they are under $800 value. There is a thing called the de minimis rule, okay? So to not pay duty, to have a treaty free. But that is appealed, so it doesn't matter anymore. You pay. So just make sure that you understand. It applies to article entered for consumption or withdrawn from the warehouse for consumption after June 30th, 2025. So right now, I know the purchase online from Tmall, from those sources of overseas, it has significantly dropped because of that. And on their receipt, you will see a tariff tax item. So, but even if some of the item you pay tariff tax, is still cheaper, but doesn't mean it is the same as yesterday. So I just want to mention to our small business owner, because when you purchase supplies from somebody, you may notice the price increase. So that may just be it because of that. Good or bad is the economy, right? It is the environment we are in. I'm not so interested in giving a right or wrong decisive answer to a certain policy change, because I really do know that certain policy in the short term might be wrong, but in the long term could be good, vice versa. So I don't really know in which way do we say right or wrong? You have to be able to stand on a timeline. If you are historians standing on 50 years later, you might be looking at today's event very differently, right? But if you are standing here in present time, like what Eckhart Tolle always say, that present. So I'm at present time. And at this moment of time, knowing what is going to happen tomorrow, maybe I say is bad, but that may not be what really relevant, really. So I think, for me, my job becoming very focused on saving. So if I can save you $5 today by utilizing a rule or regulation or tax code that only big boys knows how to do, you don't, and I do, I will use it for you to save $5. But if someone says that, oh, don't worry about the $5 saving, if you pay more taxes, you're going to save more in the future, I would trash these kind of conversation, because that person who speak that word doesn't know about future. President Trump don't even know about the future. What he does is today. What he is implementing is what he see today. And what future become is irrelevant of what he is imagining future. So don't even try to be creative on tax world. You look for the tax strategist who is grounded in the present, follow Eckhart Tolle's theory, and looking at savings today, not tomorrow. So I'm here for today. All right. Now let's take a look at our next slides. Advanced Manufacturing Credit 55X. This one is very particular to very few of our clients, because they're in manufacturing and they're getting 55X credit. So I want to show you I want to explain to you about the spirit of it. Basically, the federal government wants to wind down the incentives, want to not give those incentives. And especially if the manufacturer is utilizing foreign entities and getting supplies from foreign supplies. So they will be disqualified for that credit. So under this new OBBBA, the foreign entity of concern, the material assistance by prohibited foreign entities, they even have a acronym for it. It's called PFEs. I keep on thinking P.F. Chang, the Chinese restaurant, but it's not. It's PFEs. E stands for entity. It's a prohibited foreign entities. Okay, that disqualifies them for the credit. So the idea is wind down fast and also disallow those foreign connections. So here, example, a U.S. battery manufacturer. So we have folks that in this industry, okay? And the company built a facility in Iowa that manufacture battery cells, okay? So this particular endeavor qualified for 45X tax credit. They expected to produce 1,000 watt worth of battery cells in a year, 100,000. And they meet all the eligibility requirement under OBBBA. Production is in U.S. None of the material come from the PFEs, and the related party, unrelated party sales rules satisfied. They sold to a non-related party. Then their tax credit, look at this, is 1,000 times $35. So $3.5 million tax credit. They sold for $5 million. Okay? So that is how much that is. So with that said, that gives you an idea, right? So you may say that, oh, I'm not a battery manufacturer. Do I qualify? So those are the things you want to make sure that you explore. You may qualify. And I can tell you right here whether who else qualify, but I knew for the windmill and for the battery factories, anything for clean energy production qualifies for 45X credit. Like the solar panel, things like that. All right, my last one for today is investment credit. So let's say you are just really, wanting to know what kind of money you can put in to save taxes. So there is also, other than all these ones we talk about, right? You can purchase, if you are in the production related building property, there is 100% the new category deduction, right? And if you have interest expense expended, and if you have manufacturing 45X credit, it's a big deal, right? And if you have your R&D, there is more credit. So what is this investment credit? Taxpayer invest in U.S. facilities. That facility primary purpose is to manufacture semiconductors or semiconductor manufacturing equipment. How it works? Credit equals to 25% of qualified investment. For facility began by December 31st, 2026 and placed in service after December 31st, 2022. So how to claim? File 3468. Okay, let's look at example. Alice is a developer in 2025 planning to build a solar farm. All right? Alice wants to build a solar farm this year, 2025. The project costs $2 million for qualified solar property that under prior law would make her eligible for 30% investment tax credit. So $600,000. So she put in $2 million, she gets $600,000 tax credit. Okay? But under OBBBA, she must satisfy the beginning of the construction is before July 5th, 2026 to preserve the eligibility. So this 30% of tax credit, it is going away up to July 5th, 2026. So if you are going to do something, wanting to take advantage of the investment tax credit, there is a timeline for you. Also, you need to make sure that none of the foreign entity supply chain would disqualify your 30%. So you want to make sure you watch this. So investment credit is a big deal. 30%. 30% of the expenses. That is even more than the taxes you would pay. So $2 million, 30% is $600,000. $600,000 tax credit means that if you pay $600,000 taxes, it wipe it out clean. So in what case would you make $600,000 taxes? How much of a profit is walking away for free? I want to give you that math. I didn't really calculate, but I'm doing it right now. Okay? So you walk away because our taxes is, if you have a C corporation and a $2 million profit gives you $2 million profit, end up give you tax rate of $420,000. So you would make more than $2 million profit, you can offset the $600,000. So basically you make $2 million credit, $2 million net profit, you still don't pay taxes. You still have about $180,000 tax credit left over. So that is how significant the tax credit is. So I just want our small business owner to really understand how that works with you, right? All right. With that said, I want to say we have endless opportunities, really endless. The end of your opportunity is the limitation of your knowledge. Serious. So if you don't want to be limited with that, you want to engage people who understand these kind of things. Not just for the big companies. Yes, credit, those kind of saving, not just for big companies. Be open-minded. Ask your tax preparer, what is new for me? 2025 is a brand new year. It's a year of you should questioning yourself why you pay taxes. I'm not kidding. The big boys already said that they don't need that much of saving. They don't end up paying taxes because of OBBBA. All right? So if you pay taxes, well, then you ask yourself, what's new for me? And ask your tax preparer. They should answer that question. Or you just ask question, why do I need to pay taxes? Why the big boys don't pay? If you want to know whether they pay or not, just go on dark side of website. I'm just kidding you. During the first term of President Trump's presidency, he actually published his tax return. So that is public knowledge. You go take a look. And they don't need to pay taxes. Okay? And implement these strategies that are available before December 31st, 2025. That is something I want to mention. All of these things I was talking about has the timeline for 2025 because that is what's special for 2025. Make sure you do that. And check this year, you really should do a tax planning. You can consult with our firm to maximize your tax saving for year 2025. Sign up with our firm for a tax planning session. It is time to be strategic because the tax code, the tax rule, the big beautiful bill, all of these bills, are making tax world complex. But you need to rely on people who understand you and also understand the White House. So that is how, in combination, we can give you the most useful advices. All right, these are our partners, and you can consult with us anytime you wish. And go on to our website, you can see our availability. And this is the last slide. This serves as a comprehensive contact point for community CPA, providing essential information for potential clients that if you are interested in communicating with us. And we have emails here, phone number here, and worth mention is we operate our hours, from 8:30 to 5:30 Monday to Saturday. We open 6 days a week for your convenience. And I'll talk to you again next Tuesday. All right. Bye-bye. I hope you learned one or two. If you like my videos, thumb up, subscribe to our YouTube channel. All right. Talk to you soon.